Hello, friends. Today, I will create three different dividend portfolios. I will try to describe each one and explain which might best suit your investment goals. These portfolios will already be diversified, and I have a budget of $10,000 to work with, so I'll be basing everything on today's prices. All you need to do is follow along with me. So, without further ado, let's get started. But before we begin, don't forget to subscribe to my channel, it helps me grow. The first portfolio will focus on low dividend yields, but that doesn't mean it's bad. On the contrary, if you don't aim to receive high dividends as your primary source of income from your stocks, this portfolio might be just right for you. The first company on our list will be Lamb Weston, one of the largest frozen potato producers with clients like McDonald's. The company is going through tough times due to rising prices, but I'm confident it will perform well over the coming years. As of today, you can buy shares of this company for $57, and it has a dividend yield of 2.53%. The second company will be Brown-Forman, one of the largest producers of alcoholic beverages, which is also experiencing challenging times. However, the company has strong brands like Jack Daniel's, which generate stable profits. Currently, you can buy shares of this company for $45, with a dividend yield of 1.92% per year. The third company on our list is Mondelez, one of the largest food manufacturers in the world, with numerous brands generating multi-billion-dollar profits. Today, you can buy shares of this company for $70, and it provides a 2.66% dividend yield. The fourth company will be Zions Bank. While it's a relatively small bank, its policies have allowed it to survive several crises. I believe the banking sector will perform relatively well in the near future, which is why I've included it in this list. One share of the company can be bought for $46, and it has a dividend yield of 3.51%. Next is T-Mobile, one of the leading telecommunications businesses in the US, which recently started paying dividends. Today, you can buy shares of the company for $188, with a dividend yield of 1.38%. The sixth company on our list is Church & Dwight, which, in my opinion, is one of the best companies with numerous excellent brands. You can buy shares of this company for $98, and it offers a 1.15% dividend yield. The next company on my list is McDonald's. Everyone knows this business, so in short, you can buy shares today for $276, with a dividend yield of 2.41%. Next, we have two companies from the same sector, Waste Management for $207 and a 1.44% dividend yield, and Republic Services for $200 and a 1.16% dividend yield. Following that, American Water Works Company is included at $147 with a 2.08% dividend yield. Additionally, two more banks will be part of this portfolio, JP Morgan for $199 and a 2.31% dividend yield, and Bank of America for $37 with a 2.77% dividend yield. I also decided to add a couple of insurance companies, such as Cigna for $337 with a 1.66% dividend yield, and United Health for $589 with a 1.42% dividend yield. In my opinion, a good addition to this portfolio would be HCA Healthcare Inc., priced at $356 with a 0.74% dividend yield. FedEx for $292 also deserves a place in this list with a 1.89% annual dividend yield. Colgate-Palmolive would also be a great addition, priced at $102 with a 1.95% dividend yield. Home Depot, at $355 with a 2.53% annual dividend yield, fits well into this list. Walmart would be a perfect addition to this portfolio at $68 with an annual yield of 1.21%, while Union Pacific Corp is perhaps the last on our list at $239 with an annual dividend yield of 2.23%. Thus, I conclude the creation of this portfolio. The result is a portfolio with an annual dividend yield of 1.88%, with dividends growing at an average rate of 17.7% each year. If we take a closer look at these dividends, we can see that this portfolio allows us to receive dividends on a monthly basis. However, after studying the industries represented in the portfolio, it becomes clear that there is room for growth, but this is at your discretion. The second portfolio will be focused on companies with average dividend yield. This portfolio is suitable for those who want to protect their funds from inflation and receive stable, albeit small, profits from the stock market. The list begins with Coca-Cola, priced at $69 with a dividend yield of 2.8%. Next is Pepsi, at $178 with a 3.04% dividend yield. Following that, we have ExxonMobil at $116 with a 3.25% dividend yield and Chevron at $148 with a 4.39% annual yield. A good addition would be Procter & Gamble at $170 with a 2.37% annual dividend. Johnson & Johnson at $164 with a 3.02% annual yield is also a solid choice. Additionally, Avalon Bay at $210 with a 3.24% yield and Cisco at $46 with a 3.43% annual dividend yield are worth considering. Tyson, priced at $61 with a 3.2% yield, and General Mills at $69 with a 3.46% annual yield are excellent additions. Cisco at $76 with a 2.66% annual yield and Kraft Heinz at $36 with a 4.44% dividend yield should also be included. An unexpected addition to this portfolio would be an ETF, specifically BND, priced at $74 with a 3.37% annual dividend yield. This concludes the portfolio with an annual dividend yield of 3.26%, with dividends growing at an average rate of 3.7% each year. In my opinion, this portfolio is well diversified, although it contains the same industry issues as our first portfolio. However, I don't consider this a negative point. The point is that this portfolio contains assets that are likely to perform well regardless of the economic climate. The third portfolio will focus solely on high dividends, meaning you shouldn't expect much growth from it. The main source of income for this portfolio will be the dividends themselves, and if that's what you're looking for, I hope you enjoy this portfolio. The first companies on our list are AT&T, valued at $19.30 with an annual yield of 5.75%, and Verizon, valued at $40 with an annual yield of 6.54%. Next up is Whirlpool at $96 with an annual yield of 7.31%. Also consider adding Kraft Heinz at $36 with an annual yield of 4.43%, and Chevron at $146 with an annual yield of 4.41%. Also good options are Realty Income at $59 with an annual yield of 5.36%, and Extra Space Storage at $163 with an annual dividend yield of 4%. CVS Corp at $59 with an annual dividend yield of 4.54% also looks like a solid addition. Altria at $50 with an annual yield of 7.76% and Philip Morris at $116 with an annual yield of 4.46% would also fit well in this portfolio. UPS Store at $128 with an annual yield of 5.1% could also be a good balancer. Ford at $10 with an annual yield of 5.91% provides a decent dividend. Best Buy at $82 with an annual dividend yield of 4.46% seems to round out this list. Honestly, this portfolio looks quite risky, so I should add a couple of Coca-Cola stocks and a bond index to make up 23% of the total portfolio. The result is a portfolio that yields 4.91% in annual dividends, with dividends growing by an average of 4.1% each year. The portfolio provides significant diversification across both assets and sectors, and includes bonds for added stability. This portfolio will also provide monthly dividends. Now that I have created 3 types of dividend portfolios, I want to address this immediately to avoid negative comments in the future. I wanted to create portfolios with different dividend yields, low, medium, and high. Each of us has a different financial situation. Some need dividends to live on, while others, even at age 18, can take more risk. The goal of this video is to help investors create a portfolio that suits their needs. So, to preempt any negative comments about these results, I will rank these 3 portfolios right away so you can understand how I see them and the risks associated with them. The first portfolio, which is a low dividend yield portfolio, I would rate it a 6 out of 10. It has quite a few companies I like that will provide a steady income, but it is missing a few great companies for further diversification that I was unable to add due to the portfolio's focus on low dividend yields. The second portfolio, I would rate it a 5 out of 10. It has a number of large companies with strong brands, so they should do well regardless of the economic climate. However, this portfolio is missing a few great companies that pay smaller dividends but are growing quickly. These could add some excitement to this rather boring dividend investing that has been slightly ahead of inflation. The third portfolio, I would rate it a 3 out of 10. My goal was to create a portfolio exclusively of high dividend companies, but even after doing that and assessing the risks, I found that I needed to add a couple of positions to balance it out. I do not recommend choosing a high dividend strategy because, despite the long history, good reputation, and stable profits of the companies in this portfolio, all of them have more problems than positives. Personally, I would not invest in such a strategy. Now, I hope you were able to evaluate all the risks before choosing one of these portfolios. Personally, I plan to create a personal portfolio that will include most of these companies, so if you do not want to miss the portfolio that I will rate 10 out of 10, subscribe to my channel. In the future, I will also track all these dividend portfolios to evaluate which strategy is better based on the results.